Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about capital markets. We're going to focus on the big picture a little bit, 40 years of returns that we're going to examine. Now, that's important. I don't want to discount short-term volatility. We live all the time in periods of uncertainty. We live in a very complex world, and it's virtually impossible to predict in the short term what capital markets are going to do and what the impacts will be to markets, whether it's politics, trade laws, skirmishes from an economic or military standpoint. Of course, we have the tragic war in Ukraine, which has an impact for sure right now. But for all of us, we need to step back on some part of our portfolio and just reflect on what happens over time. I'm going to show you a chart that was put out by Fidelity Investments that gives us a perspective over the last 40 years on different asset classes. I thought it was a really helpful chart. I think you'll find it helpful as well. If you are 5, 10, 15 years away from using your retirement assets, then this will be, I think, an encouragement. But even for those of you that are already retired, you're using your financial assets, it's unlikely that you need access to all of your capital tomorrow, 3 years from now, 5 years from now. And so let's take a look at the information together, and I think you'll find it encouraging. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement income planning and overall wealth planning. So if you don't want to miss future content, hit that subscribe button. Okay, let's take a look at this Fidelity research piece that was put together and see what kind of lessons we can extract from this piece. Okay, this was information that Fidelity Investments put together. It's titled Focus on the Big Picture, 40 Years of Returns Examined. And I like their introductory paragraph. It really sets the stage for this particular visual. Many events have affected markets in the past. However, over the long term, markets have historically bounced back. Investors who stayed the course increased their wealth. And as you can see, the longer they stayed invested, the better. I know this sounds like a very simplistic message, but at the end of the day, time is the investor's best friend. And there's lots of strategies out there about trying to be cute around markets, trying to anticipate markets. But at the end of the day, various investments have certain kinds of return characteristics, and I suspect those return characteristics will be similar in the future. So if you look at this chart, what it does on the right, it gives you the various asset classes. So at the bottom is Canadian inflation, Canadian T-bill or government short-term bond rates, Canadian 5-year GICs, Canadian equities or stocks, Canadian bonds, U.S. equities or stocks, and U.S. small cap equities or stocks. Now, what we're looking at is portfolios that started at a particular investment value. Let's look at it. So the graph has a $10,000 initial investment value, and so that's illustrated right here. And we're looking at the various return patterns. Now, this chart, when you take a look at it, really is a good visual object lesson for when we talk about risk or volatility. Really what we're talking about is short-term volatility or swings in return. So we've often talked about the fact that we can have great quality investments, but because of geopolitical risks or economic events, they're going to fluctuate. So when we look at retirement portfolios, we embrace this idea of timeline investing. How much money needs to be in the shorter term for income and liquidity over the next 3 years? How much money needs to be at the ready over the next 4, 5, 6, 7 years? And how much money doesn't really need to be tapped into for another 8, 9, 10 years? And that should influence your investment decisions. And you can see why. So if I look at the various investment categories here, over this time period, so again, if we look at from basically December 31st, 1981 to June 30th, 2022, the inflation of that $10,000 basically drove the value of that $10,000 to $29,297. That's using the inflation rate. If I take a look at T-bills, so government guaranteed bonds, short-term bonds, $10,000 grew to $65,632. If I take a look at 5-year GICs, that was an average of 5.3%. It grew to $79,912. So we had 2.7%, we had 4.8% compounded, we had 5.3% compounded. And then if we take a look at the next category, that's basically Canadian stocks, the broad index grew at 8.8%, and it grew to $296,429. And if we take a look at Canadian bonds over that time frame, 9.1%. So very interesting that Canadian bonds outperformed Canadian stocks over that time period. It grew to $329,086. So these two numbers here really illustrate one lesson maybe that we should take from this, is that global diversification and not having all our money in Canada probably is a wise investment decision, because the Canadian market really underperformed. Now, what's interesting about this chart, you might ask yourself, why would bonds outperform Canadian stocks over that time period? There's a lot of different reasons, but one reason was over this time period, interest rates steadily declined from the early 80s right through to 2022. And there's an inverse relationship between interest rates and bond prices. As rates come down, bond prices go up. In fact, we'll have a link right now that'll show up on the screen. If you click it, it'll take you to a video that we produced called Loanership Investments, where we talk about how bonds behave. And that's one of the reasons why this looks like a bit of an anomalous result. If we look at the green chart here, which is U.S. equities, compounded 11.7%. That $10,000 grew to $830,000. And the best performing category were U.S. small cap stocks at 11.7%. And that was $846,431 total value. Now, what you see here in this chart as well is the various events. So you look at the early 80s, Paul Volcker raised interest rates. He was the Fed chair at that time, raised rates dramatically to curb inflationary pressure. We had the Dow do a free fall, Black Monday in 1987. We then had the Berlin Wall crumble in 1989 in November. We had the Russian central bank stop supporting the ruble and allowed it to collapse in 1998. We had the global financial crisis in 2008, and we had the U.S.-China trade war over this time period. So these geopolitical events are always going to be a fact of life in a chaotic, complicated world. But if you step back and look at this chart, and if you timeline your portfolio, then the lesson here is that equities, these categories up here, U.S. equities, small cap, big cap, can play a pretty important role. And the above average performance from quality stocks is huge. It makes a very big difference in terms of the terminal value of your portfolio. So as you get closer to retirement and you're looking at how to structure your portfolio, the life expectancy of your portfolio does not end at age 55 or 60 or 65. You're going to have another third of your life to live. And when you take into account the reality of purchasing power risk because of inflationary pressure, tax costs, or longevity, having growth in your portfolio makes sense. And I think this chart really confirms that. One last point I didn't talk about in any detail is taxation. So if you look at T-bills, GICs, and bond portfolios, a good portion of the return on those investments are fully taxable. So interest income, if it's in a corporate investment account or a non-registered account, is fully taxable. Obviously, you don't have to worry about that within your RSP accounts or your RIF accounts or your tax-free savings accounts. But for those of you that have built up investments corporately or in your non-registered accounts, there's a lot of tax you have to pay. Whereas with your stock portfolio, not only are the returns better, but the after-tax results are better because you'll be getting some dividend income, some capital gains income, or deferred price appreciation through capital gains, which triggers a lot less year-by-year tax on your portfolio. Anyway, I hope that you found this update and overview helpful. Again, if you haven't subscribed, make sure you do that. Click the link. If you like the video, make sure you click like. And if you're within 5 years of retirement or already retired and you'd like to get a second opinion about whether you're tracking in the right direction and a complimentary retirement planning analysis, in the show notes is a link to our website where you can get more information about how to get that complimentary analysis. As well, on our homepage, there are free retirement planning and investment planning resources that you can tap into to improve your knowledge, which always leads to better outcomes for individuals as they plan their finances. Anyway, wishing you all the best in your retirement income planning and overall wealth planning journey. You take care. Bye-bye.